Welcome to The Explainer. I want you to think of what we're about to cover today as an urgent strategic intelligence briefing. We're going to completely unpack the massive macroeconomic forces and really the stark geographical divides that are driving the next wave of the global AI economy. Because you see, this isn't just about microchips or writing code anymore. It's a story about global power. It's about human psychology. And crucially, it's about exactly where the capital is moving right now. We'll be breaking down a concept called the velocity trap and uncovering the massive fundamental paradox sitting right at the heart of global AI adoption. Okay, let's dive into this because here is a number that should absolutely haunt every entrepreneur, investor, and policymaker tuning in right now. $500 billion. Just let that sink in for a second. That is the projected AI-related hyperscaler spending target for the year 2026 alone, not spread out over a decade, just one single year. To really wrap your head around the mind-boggling scale of this capital deployment, you have to realize that capital expenditure by heavyweights like Microsoft, Alphabet, Amazon, and Meta is expected to rise by more than 34% again in 2026. Morgan Stanley is estimating that nearly $3 trillion in AI infrastructure investment will flow through the global economy by 2028. It's literally staggering. But here is where we hit the absolute core paradox of the current market. It's a massive collision. On the supply side, we have skyrocketing infrastructure investment, that 34% year-over-year growth we were just talking about. But on the demand side, we have a totally stagnant, hesitant reality. Right now, 65% of American workers still say they don't use AI much or even at all in their day-to-day jobs. So we're witnessing exploding supply-side investment aggressively crashing into a wall of hesitant demand. All this money is building something that a huge portion of the country is still completely unwilling to fully step inside. Section 1. America's AI Trust Deficit. To really understand why this massive disconnect exists in the first place, we have to look closely at human emotion and anxiety. We tend to think of technology as just pure math and silicon, right? But public perception is currently functioning as a very real, highly measurable macroeconomic variable. According to Pew Research data, 65% of all Americans agree that AI is advancing too quickly, and that consensus crosses age barriers, it crosses geographic divides. The American public collectively feels that this technology is moving just way too fast to be safe, secure, or governable. And as an investor or a builder, you just cannot ignore this. This isn't just a sentiment survey, this is a glaring economic signal. Because that anxiety, it translates directly into behavior. Right now, 51% of Americans still do not use AI chatbots. Think about that. Over half the country is actively avoiding the single most accessible form of this technology. From a market perspective, this represents an enormous latent market that is currently slamming headfirst into a solid adoption ceiling. If the public cannot trust the technology or the companies deploying it, that $500 billion spend we talked about earlier is going to face a massive, massive bottleneck. So the crucial point is this. Trust deficits become market frictions. When the actual users of a technology believe it moves too fast to be safe, adoption plateaus. And when adoption plateaus, it creates this enormous, heavy friction against the billions of dollars being poured into the infrastructure. You simply cannot force an anxious market to adopt at the speed of your capital expenditure. It doesn't work that way. Section 2. The infrastructure competitive moat. So let's pivot from the software layer down to the physical hardware layer because the competitive moat here is incredibly steep. The ability to finance, build, and fuel the physical infrastructure of AI, that has become the defining advantage of our current era. $12 billion. That is the staggering average cost just to bring a single 250 megawatt AI data center online. And yes, that includes the equipment inside. The physical footprint required to run these models is just astronomically expensive. But surprisingly, the ultimate bottleneck for this massive capital expenditure isn't actually money. Believe it or not, it's electricity. Goldman Sachs estimates that global data center power demand will surge by 160% by the year 2030, strictly due to AI workloads. We are entering an era where securing a reliable energy grid is just as critical as securing cutting-edge semiconductors. Power, not capital, is the true constraint moving forward. And because of this intense, ravenous need for land and power, we're seeing a fascinating geographic migration. Right now, 87% of existing data centers are located in urban areas. But get this, 67% of planned data centers are heading out to rural areas. The infrastructure is actively migrating out to rural America just to secure the necessary real estate and electricity.
Yet the irony here is that the ultimate AI adoption benefits, the real economic gains, they remain heavily concentrated in connected cities. So the capital flows out to the rural land, but the actual value capture flows right back to the urban centers. All of these immense pressures, the massive spending, the public hesitation, the critical infrastructure bottlenecks, they all combine to create what we call the velocity trap. This is essentially a state where the sheer speed of technological deployment creates compounding opportunity costs that most businesses are just structurally unprepared to navigate. Companies are caught between a rock and a hard place, right? They're trapped between the risk of deploying prematurely, which brings technical debt, regulatory blowback, and workforce disruption, and the fatal cost of waiting and falling permanently behind the innovation curve. Let's move to and see how this builds over a brutally short time frame. We call this the 18-month delay paradox. Unlike traditional industries, AI product generations don't just improve incrementally, they completely redefine the landscape. Let's say in month 1, you decide to pause deployment to ensure safety and wait for public trust. Totally reasonable, right? Well, by month 6, your competitors' capital intensity is peaking. By month 12, they are building compounding advantages against you. By month 18, an entire market generation has been completely missed. An 18-month delay in AI doesn't just mean you're a little bit slower to adopt. It pretty much guarantees immediate obsolescence. Every month without AI infrastructure is a month without AI-driven revenue.
Section 3. The global inversion, economic liberation. Now, everything we've discussed so far, the sluggishness, the hesitation, the market friction, that is largely a United States problem. When you contrast the US with other global realities, it's night and day. In the US, market sentiment is heavily weighed down by this deep fear of job displacement, severe trust deficits, and regulatory risks. But look over at the global South, countries like Kenya, Brazil, India. There, sentiment is driven by overwhelming optimism. AI is viewed as an incredibly powerful tool for extreme upward mobility, financial inclusion, and pure economic liberation. And where AI is seen as a tool of liberation rather than displacement, the adoption velocity accelerates tremendously. So the major takeaway here for your strategic intelligence is crystal clear. The AI trust deficit is largely a localized US phenomenon. The friction caused by fear is domestic. But absolute necessity is actively forcing hyper-fast adoption in the global South. For investors and builders paying attention, the true, uninhibited market opportunity is entirely global. Section 4. The DeFi and AI convergence. So how do we practically target these high-velocity emerging markets? Well, it happens through a specific technological convergence that entirely bypasses traditional, sluggish banking infrastructure. And this brilliantly illustrates exactly how that value engine works. Step 1, agentic AI acts completely autonomously, executing financial transactions, managing wallets, and optimizing yield strategies for everyday users who don't even have traditional bank accounts. Step 2, blockchain technology steps in to verify the trust of that infrastructure, ensuring total compliance and security without needing a centralized middleman. Step 3, the platforms that successfully combine that AI agency with blockchain verification capture the entire next value cycle. They're delivering immediate, life-changing financial utility to the unbanked populations of the world. However, we have to be careful here. Even in the global South, where the adoption window is literally measured in months rather than years, a critical warning remains. As the source material puts it, necessity is forcing adoption, but adoption without trust is a platform with no foundation. While these markets are adopting at lightning speed out of sheer necessity, the underlying architecture we build absolutely must still guarantee safety, governance, and equity. If it doesn't do that, then it isn't true transformation, it's just extraction. Section 5, the global investment imperative. And this brings us right to the climax of our strategic briefing today. The macro shifts are undeniably clear. We are moving from US market friction to massive, unprecedented global opportunity. We have to fundamentally reframe how we view this entire space. The reality of the AI market is that it is no longer just a technology story. It's an economic story. It is a global power story. And for half the world living without reliable banking infrastructure, it is a story of profound financial liberation. A technology powerful enough to completely redraw the map of global wealth has been released into the wild, and the resulting economic transformation is already well underway, reshaping our world in real time. Which leaves us with one final vital question to consider as we wrap up. Who will design the institutions, the interfaces, and the frameworks to ensure this transformation actually creates value for the billions waiting at the edge of the digital world, rather than just enriching the few who got there first? The answer to that is being written right now by builders in Lagos, Nairobi, and Sao Paulo.
The signal is live, so the only question left for you is, are you actively transmitting your own strategy, or are you just waiting around to be disrupted?